China is destroying its own currency on purpose right now, and they're making billions doing it. Trump called it cheating. Economists call it genius. And your wallet? It's caught in the crossfire. You think a strong currency is always better? Dead wrong. China figured out something most people never understand. Sometimes weakness is the ultimate weapon. I'm Max, and in the next 15 minutes, I'm going to show you the dirtiest trick in international finance and why it's probably happening to your money right now. I break down the financial games governments play with your money, the moves they don't want you to understand. If you want to know what's really happening to your purchasing power while politicians lie about inflation, subscribe right now. This is the real game. Let's go. 2025. Trump slams China with tariffs. Over 200% on some products. Massive. Historic. China should be destroyed, right? Wrong. Their exports, still flooding America, still cheap, still undercutting everyone. Trump loses his mind. China is manipulating their currency. He's not wrong. But here's what nobody's telling you. This isn't new. This isn't illegal. And the US, they've done it too. The game is rigged. The question is, who's playing it better? By the end of this video, you'll understand why the Plaza Accord of 1985 destroyed Japan's economy for 30 years, and why it might be happening again. Stay with me. First, let's get clear on what we're talking about. Currency devaluation. When a government deliberately makes its own money weaker. Not accidentally, not naturally. On purpose. This is different from depreciation. Depreciation happens naturally when an economy sucks. Investors panic, sell the currency, value drops. Market forces, natural. Devaluation, that's a government pulling levers behind closed doors. Calculated, strategic, weaponized. Then there's the term everyone throws around, currency manipulation. Here's the truth, it's mostly a political buzzword. There's no official definition. Every country manages their currency to some degree. It's normal economic policy. But when does it become manipulation? When other countries don't like it, when you're not transparent, when you push your currency down for too long, making your exports unfairly cheap, at least according to your competitors. So when Trump labels China a currency manipulator, is he right? Technically, maybe. Politically, absolutely. But here's the kicker. The US has done the exact same thing. We'll get to that. Right now, you're probably thinking, wait, why would anyone want a weaker currency? Isn't strong always better? That's what they want you to think. Let me show you why you're wrong. What I'm about to show you in Section 2 will change how you see every economic headline for the rest of your life. This is the secret. Why would any country want a weaker currency? Sounds insane, right? Like financial suicide. But in macroeconomics, it's a weapon. Here's how. Reason number 1, cheaper exports. This is the big one. The reason China does this. Let me break down the math so simple a politician could understand it. Maybe. Setup. $1 equals 7 Chinese yuan. A Chinese factory makes a toy, sells it for 7 yuan. In America, that's $1. Simple. Now Trump adds a 30% tariff. Suddenly that toy costs $1.30 in the US. Not cheap anymore. American buyers start looking elsewhere. Chinese factory is screwed. China's move? Weaken the currency. Now $1 equals 8 yuan. Same toy. Still 7 yuan in China. But when converted to dollars, 88 cents. Add the 30% tariff, $1.14. Boom! China just canceled out most of Trump's tariff without changing a single thing about their product. No cost cuts, no profit sacrifice, just currency manipulation. But Max, that's only a small change. 7 to 8. Big deal. Big deal. When your exports are worth billions, even tiny devaluation has massive impact. A 1% currency move on a $1 trillion export economy? That's $10 billion in competitive advantage. For free. This is why Trump screams about the dollar being too strong. When the dollar is expensive, American exports can't compete. We're pricing ourselves out of global markets while China undercuts everyone. Reason number 2, invisible tariffs. Wait, more expensive imports are good? Stay with me. When you devalue your currency, imports get more expensive. Foreign products cost more. Your citizens start buying local instead. It's the same effect as a tariff, but slower, sneakier, and it doesn't break any trade agreements. No retaliation, no trade war escalation, just quiet economic warfare. Of course, this also causes inflation, same as tariffs. There's no free lunch, but politically, way easier to sell. Reason number 3, debt destruction. This one's sneaky as hell. Let's say a government borrows $1 million from its own people. Years later, they print money. Inflation goes up. Now that same $1 million only buys half as much, but the government still pays back only $1 million. In real terms, they're repaying with cheaper money, money that's worth less than when they borrowed it. Inflation shrinks the real value of debt. It's a hidden tax on savers and a bailout for borrowers, especially governments. But there's a catch. This only works when the debt is in your own currency. If you borrowed in US dollars, you're screwed. A weaker local currency makes that foreign debt more expensive to repay. Pretty sneaky, right? So how do countries actually do this? Do they just change the numbers? Not quite. But the methods they use are shadier than you think. Section 3 is where it gets dirty. You might be thinking, okay, Max, so how does a country actually weaken its currency? Do they just type new numbers into a computer? Kind of. But there are specific tools they use, 3 main ones. Method number 1, cut interest rates. This is the central bank's move, not the government's directly. Yeah, they're technically different entities. Here's how it works. When US interest rates are high, investors can make big returns buying US government bonds or parking money in American savings accounts. To invest in America, you need US dollars. So investors buy dollars. Demand goes up, dollar strengthens. Want to weaken the dollar? Do the opposite. Cut interest rates. Now bonds pay less. Savings accounts earn nothing. Investors lose interest, literally, and sell dollars. Less demand. Dollar weakens. It's supply and demand. Basic, but powerful. Method number 2, print money, quantitative easing. Oh yeah, the classic move. QE, quantitative easing. Sounds fancy. It's just printing money. The central bank creates new money out of thin air. Yes, literally, and uses it to buy government bonds from commercial banks. Banks now have fresh cash. They lend it out to businesses and people. More money in circulation? Inflation. And inflation? That destroys the value of the currency. Mission accomplished. The US printed trillions after 2008. The Fed's balance sheet exploded. And guess what happened to the dollar's value relative to gold, real estate, stocks? It got crushed. That's not an accident. That's policy. Method number 3, foreign reserve manipulation. This one's fast, expensive, and requires massive reserves. China is the master. Unlike the US, where the dollar floats freely in the market, China doesn't let that happen. The Chinese government sets a daily target exchange rate for the yuan. If the yuan starts strengthening too much, bad for exports, China floods the market with yuan. Supply goes up, price goes down. If the yuan falls too fast, China uses its $3 trillion in foreign reserves to buy yuan back. Demand goes up, price stabilizes. This method is incredibly powerful, but expensive as hell. You need insane reserves to pull it off. China has them, most countries don't. So there you have it, 3 weapons: interest rates, money printing, and reserve manipulation. Every major economy uses some combination of these. The question isn't if they're doing it, it's how much. Now here's the uncomfortable question: is this cheating? Trump says yes, China says no. But wait until you hear what the US did in 1985. Section 4 is going to blow your mind. Is currency manipulation cheating? Let's ask the US government. Because in 1985, they did exactly what they're accusing China of now. 1985. The US was running massive trade deficits, especially with Japan. Japan was the rising economic superpower. Made in Japan was taking over the world. American manufacturers were getting crushed. So what did the US do? They called a meeting. Plaza Hotel, New York, the US, Japan, Germany, France, and the UK. They made a deal. Everyone agrees to weaken the US dollar on purpose. It was called the Plaza Accord. How'd they do it? Japan sold massive amounts of US dollars from their reserves and bought yen. More dollars in the market? Dollar weakened. Less yen in the market? Yen skyrocketed. The yen's value doubled. Japanese exports became insanely expensive overnight. Japanese businesses started bleeding profits. Panic set in. Japan's response? Cut interest rates to zero. Print money, flood the economy with cheap loans. And guess what happened? The Japanese public went crazy. Cheap loans everywhere. They borrowed heavily, invested in stocks, bought real estate. Speculation exploded. Asset prices went to the moon. Then, the bubble popped. 1990. Stock market crashed. Real estate collapsed. Banks failed. And Japan entered what economists call the lost decades. 30 years of economic stagnation, all because of currency manipulation orchestrated by the US. So when Trump points at China and screams currency manipulator, yeah, he might be right. But the US wrote the playbook. 2019, Trump's treasury officially labels China a currency manipulator after the yuan weakened past 7 per dollar. China denied it. No punishments happened. The US quietly dropped the label in 2020. Why? Because everyone does this. It's not illegal. It's just economic warfare with extra steps. After the 2008 financial crisis, central banks around the world started cutting rates and printing money simultaneously. Everyone trying to weaken their currency to boost exports. It became a currency war, a race to the bottom. The danger? When too many countries do this at once, you get global inflation, market panic, and broken trade relationships. Nobody wins, everyone loses, except the people who own assets. So is it fair? Depends who you ask. The country doing it says they're protecting their economy. Competitors say it's unfair. And when everyone does it, the game is rigged for everyone. But here's what nobody talks about. This doesn't just hurt countries, it destroys you. Section 5 reveals who really pays the price for currency wars. And spoiler, it's not the rich. A weaker currency sounds smart, right? Helps exports, protects local businesses, shrinks debt. But who actually pays for this? Not the government, not the corporations. You do. Consequence number 1, inflation. When your currency weakens, imports get expensive. Food, oil, electronics. Everything you buy from other countries costs more. Prices across the board start rising. Countries like Turkey that depend heavily on imports, they get destroyed by inflation when their currency falls. Meanwhile, countries like China that produce most things locally, they survive better, even profit. But even if your country produces locally, guess what? Companies see prices rising and raise their prices too. Because inflation. Everyone uses it as an excuse. Your cost of living explodes. Consequence number 2, your salary gets eaten alive. Your paycheck stays the same. Maybe grows 3% a year if you're lucky. But living costs rising 7, 10, 15%. You're technically earning the same amount, but in reality, you can afford way less. This is the hidden tax. Nobody voted for it. Nobody approved it. But your purchasing power just got cut in half while politicians tell you the economy's doing great. Consequence number 3, the rich get richer. Here's the kicker. When inflation rises, what do smart people do? They don't keep cash. Cash loses value. They buy assets, real estate, stocks, commodities, things that hold value or go up during inflation. Asset prices skyrocket. If you already own a house, stocks, land, congrats. You just got richer while doing nothing. But if you're living paycheck to paycheck, if your salary barely covers rent and food, you can't invest. You can't buy assets. You just get poorer while watching everyone with money get richer. Currency devaluation doesn't just create inflation. It accelerates wealth inequality. The people with assets win. Everyone else loses. And countries can't just keep devaluing forever. If inflation spirals too much, people lose trust in the currency itself. And once trust is gone, the currency becomes worthless. See Venezuela, see Zimbabwe, see Weimar Germany. So yes, currency devaluation can be a useful tool, but it's not a free win. It's a transfer of wealth from the poor to the rich, disguised as economic policy. So what's the conclusion? Is a weak currency good or bad? Is it cheating or strategy? The answer is all of the above. A weaker currency can help exports, protect industries, and shrink debt. Countries like China, Japan, and Switzerland have used this when it suits them. It's a legitimate tool, but it's not without consequences. A weaker currency raises prices, hurts salaries, widens inequality, and triggers inflation, especially if your country depends on imports. Is it cheating? Is it smart? Or is it just survival in the global economy? Yes, to all three. Here's what you need to understand. This isn't about right or wrong. It's about power. Who controls the money? Who benefits? And who pays the price? Governments will keep playing these games. Central banks will keep printing. Currencies will keep getting manipulated. The question is, are you going to keep holding cash and getting destroyed? Or are you going to protect yourself? Because in the end, it's not about strong or weak currencies. It's about who owns assets and who owns nothing. The game is rigged, but you can still play it. If this changed how you see money and power, subscribe. Next video, how to protect your wealth when governments destroy their currencies. You'll need it. I'm Max. Don't trust governments with your money. Trust math.